All right, so let's take a look at chapter 12 here. So in chapter 12, what we're going to look at is bonds and notes payable. And so what we're going to look at is different options. We looked at last chapter, we looked at chapter 11 about dividends and stocks, preferred stocks. And we're also now going to start looking at, and this first problem we're going to work on is really analyzing and seeing which is the best route for the company. As in, how do we fund things? Because that's how we fund things, is through maybe issuing common stock, issuing preferred stock, or maybe even issuing bonds. And so those are ways we fund ourselves. But there's different things that happen by doing each of those things, and they affect different things. By issuing additional common stock, we lower our earnings per share, right? So that's some of the things that we have to take a look at. Also, issuing additional debt and bonds, we lower our debt ratios and our leverage ratios. And so those are things that we have to look at. So we'll take a look at two different plans and what it means to us. One of the nice things about the bonds is we can take some of that interest and we don't have to pay, we're not going to pay taxes on them as a part of that. But and the difference between the dividends, we will be paying taxes on those. So we're going to take a look at some of these things on this problem here. So let's start with the 12.1a, E12.1a on page 567. So as you're taking a look at the problem here, we are going to basically analyze the problem and figure out which is the best way to do this. So on page 544, you'll see an example there that kind of walks you through what we will be doing here. As you see in the example here, you have the earnings before bond interest and income tax. We'll figure out our earnings, which we have here, on the same as our problem here. Then we'll deduct the interest on bonds, and that will give our income before income tax. And so that helps. Remember that deduction of the bonds, what we're paying on that interest, will help lower what we're paying in taxes. So that's a positive in that respect, but again, there may be some negatives too on that. So we'll take a look at this problem. So I'll let you take a look at it and work through a little bit of it using that template on 544 to kind of walk you through. I'm going to start writing down everything that's on there, so that'll give me some time to do that. So if you want to work through the problem.
It's PR, right?
Yes, it's, yeah, PE. So that's on page 567. So it gives us the the earnings before bond interest and income tax as 1.2 million. That's what it states in the problem there. Now we have two plans here. We're going to try to figure out what's the best plan we want to do as a company. So we're analyzing these type of things. So we want to deduct, the first thing is deduct interest on bonds. It tells us that we have issued a bond at face value. That means we've issued it for that amount. So we're paying 6% interest on that. So with 6%, what are we paying for as an interest that first year on plan 1? What's 6% of the 6 million?
360.
Yeah, 360. Yeah. And then the next one was 6% of 5 million. That'd be 300. So the 300,000 and the 360 is what we have there. And then we take that away. Because you need income for income taxes for each of those. All right. And then we must deduct our income tax. Well, what tax bracket are we in? 40. So we take 40% times that. Yes. So I'll put 40% there just so you guys remember that. So 40% of this, that's what I get 40% of.
336 and 840.
336. What's this one?
360.
That sounds right. All right, so 540. So how are we doing here? So as you can see, our net income's a little higher on this one, just because we're paying less on the bonds. But then we have another issue here. So what do we have in dividends on preferred stock? Do we have any here? So we don't have any on the plan 1. What do we have on dividends in plan 2? Well, since we have $3 million, $3 par. So looking at your example there, yeah. So we issue preferred $3 stock and $30 par. And we have $3 million as our what we're paying out. So to figure that out, take the $30, the 30 par, right? We have there, and divide that into your 3 million. And that will give us how many shares there are out there. So that'll be, yeah, 100,000. And then what are we giving them as their dividend? $3, so multiply that by 3. So what do you come up with there? Oh, what is that? 300,000, yeah. 300,000. All right. So now we got to figure out what we have available for dividends here. For common stock, we have 504, right? What do we have on this one? 240. that's what's left over.
Professor, so could you go over that again?
This one?
Yeah.
All right, get that there, that number. So what we did to figure out how much we have there, we took the, we had $3 million. We took divided that by 30.
The $30 par?
Yeah, the par value of that. To give us, that means we have 100,000 basically shares that we have in there. And then we're taking that 100,000 times the 3, because that's what we're paying out.
Okay, $3 per share.
Yeah.
Why is that a 0 on the other one?
Because they didn't have any, the plan one.
Oh, okay.
Yeah, they didn't have anything on the plan one, they didn't give them, so there was nothing on that. Because in this plan, they had none there, they had more bonds. And that's the difference, in that, the two different plans. So we good here on how much we have available? Okay, so how many shares do we have outstanding in each of those? So it tells us we have $20 par, so we're going to take $20 into the 6 million. We figure out how many shares we have. And then the 4 million. So how many shares do we have there?
Of 6 million, it's 300,000.
300,000?
Yeah.
Okay.
Did you go that into
So we basically,
Taking up
we're
with the
taking
last
the,
one.
yes, it's similar to that last one we just did. Because we were saying that we have this much of par value, so it's $20 par value, right? For those common stock. We have $600,000 we're issuing out there. We're issuing out 600. So I'm trying to basically figure out how many shares I have. These are the shares that I have. So I took 6 million divided by 20, and then 4 million divided by 20. Because I'm just trying to figure out how many shares I have.
Okay.
These are not in dollars. And this is in dollars here, but this is not in dollars, so it isn't not shares. And to figure this last part out is, then earnings per share, I'm taking this divided by that. And remember that equation that we did? I don't remember what problem that was. It was like the third problem we did tonight. When we took earnings per share, it was net income minus preferred stock over number of shares. And that's what we're doing right here. So it's basically it's a very similar thing here that we're figuring out. So we're taking net income, we subtracted out the preferred stock. That gave me these values here. That gives me the top of it. And then these are the shares that are outstanding that we're divided by. So what do we come up with here?
1.68.
1.68?
First one.
Okay. That's 2. Is that 1.2?
1.2.
Okay. All right, so that's what we're doing to figure all of that out. Oops, sorry, I'm answering your way.
Yeah, now that we're taking pictures.
Now, one of the things you're going to look at here is that this has a lot. Plan 1 has a lot of higher earnings per share, so that's looking a lot better to our stockholders on that side. The bad thing is we have a lot more interest out there as a part of that also, though. And we have more. We took more out in bonds, so that hurts our leverage a little bit too. So those are some things to just kind of look at. Each company is different because of where they sit. If they have lots of cash, well, they don't mind putting out some bonds. It's not too much because their leverage they're very strong with their leverage. Where other companies may not. So companies like Apple, they are using their cash in different ways. So they may have to put out a bond, or a lot of them are asking them to put out a preferred stock for them because they have lots of cash there, but they're using the cash for something else. They're not all telling us about. They're going to build a whole new campus for everybody. So in the next year and a half, start construction on that. It costs about $5 billion. Yes. It's supposed to look like a spaceship. Well, it's supposed to be big around, so, yeah, Cupertino, so. That's what you can do when you have lots of cash. We'll talk about cash next week. I should have probably brought that up then. Let's see, the cash flows. All right, moving forward here. I'll probably bring it up again because I'll forget I told you. 12-2A, let's take a look at that one. So questions on this one here? So we're just taking a look at different plans, and that's kind of what we'll do in a little bit of this chapter too. So a good example of this one is on page 547. So if you want to take a look at that page. That's in the middle of the page, issuing bonds at a discount. Now what happens here is, when we take a look at bonds, sometimes we issue them at discounts or premiums, depending on what the market rate does. Because if we are offering at 5%, I'm the company here, I'm Google, and I decide to offer a 5% bond, but the market rate is 6, who's going to buy that? If everybody's getting 6% on all their bonds, who's going to buy mine at 5? Probably not very many people. So I have to then discount it to enhance them to purchase my bond. So that's what you're doing there, is giving them a discount a little bit so that they would purchase your bond, you know, instead of the other bonds that are out there. Because if we're weighing them, you know, maybe it's Google and Apple, they're pretty much, they're similar in some ways, but maybe they're on the same financial footing and they've got AAA ratings, and you have a good chance of getting paid back. I would obviously take the company that's going to pay me a little higher interest rate, right? Unless you give me a little discount on it, and that's what we're going to take a look here, is discounting and then also paying premium. Because sometimes we need to charge a premium for my bond because I am the company that's charging 7% or giving 7% interest, and all the other companies are only giving 5%. Because that's when I put it out there and the interest rates just dropped, and so this is what we have ours at. So now I need to charge a little more for that because I'm giving them a little more, right? So that's some of the things that you're looking at, the differences there. All right, so let's take a look at 12-2A. So again, a good example of this one, I'll give you guys a moment to work on this, is on 547. Now this problem isn't so bad because they really give you most of the information. There's no real figuring anything out, other than just a little basic math equation that you can figure out here. So this problem, basically what we're doing is we're issuing a bond. We issued it at a certain price. Was it above or below what we were supposed to charge them? Any other thoughts on that? So remember, it's a $2 million bond. We issued it for, they paid us $1.9 billion and some change. So with that, we're getting a discount. There's a discount on that. Give it a discount. All right, so we have cash. Now what we received how much cash? 1920873. Okay. And then we had a discount there. So what's going to be the discount? Because we're supposed to have we're supposed to be having a $2 million bond here, right? And so because this, we gave a discount, that's what's gonna fill into here. And then over the time, the discount will go away. Because what we're gonna happen is, every time we pay interest, part of the interest we're paying is gonna be going into this, our interest expense. That's a part of that. So, how much is that?
79127.
79127. And so that's how I read this journal entry for that. And what you're looking at here on this is that we would also have, and we're not going to have to journalize this, this is this problem here, but you would also journalize each time we have to pay that semi-annual interest. So each time I have to pay 8% times a half, because I'm doing it twice a year. So I pay 4% of the $2 million each, maybe June 30th and December 31st, whatever we decide that's going to be. Then usually that's good times. All right, questions on that problem? All right. So let's take a look at the next one here, which is 12.7a. So now we're going to look at journalizing installment notes. Now, one of the things as you look at bonds and installment notes, bonds here, as you look at these, and just want to just briefly touch on this real quick, is that bonds, you just pay the interest until they come due. So if I have a 5-year bond, I pay you interest for those 5 years, and at the end of the 5 years, I then have to pay you the full amount back. So that $2 million, I have to pay it. So I will pay that at the end of that. Now there's callable bonds also, which are able to, you can call those back in and pay it early. Some of those, or there's bonds that you can actually transfer into stock if you want to. So those are called convertible bonds. Those are more in-depth things. Those are some of the things that you can do with bonds. But just remember that you pay the interest, then you pay the full amount at the end. So it's not like our mortgage where you pay a little bit of principal and the interest, and then near the end we start paying a lot more principal and then interest, a little bit of interest. It's a little different than that. All right, so a good example for 12.7a is on page 554. Now, as you look at this one, this is a little different than what I said on bonds. Remember I said you pay it all at the end, right? The bonds, this one's an installment note, similar to what we would have in a mortgage. This is something that we would pay some interest, some principal. And so that's what we're going to do here. So I want you to journalize this one. I'll give you guys a few moments to do that. All right, as you're taking a look at this problem here, what you'll see is that we're getting some money in, right? That's why we're going to debit cash. So we'll debit cash because that's why we are doing this note, is to get money in so we can do anything with expansion or whatever we're going to do. So how much money are we getting in? 80,000. All right. What then do we owe? What are we going to credit? Notes payable. Because we have that obligation, that liability, we now owe them money. So in here, again, we debit our assets, and we're creating a liability. And we're on this additional money there. All right, so the second part of the problem says, well, now let's journalize the first annual note payment. So we're making a note payment here. And so, what are we going to debit on this? Because we're paying a couple different things, aren't we? What are we paying? Interest, so we have principal and interest. So we have interest, expense, and then we have, we're going to be paying our principal, which you just said, which is our notes payable. Because we're paying that down, now we are going to debit that. So what was our interest expense? 5,600. And then what was our notes payable? 84. 9,000. 734.
Oh, maybe, I'm not wrong.
224. Was that?
So 9,200.
Yeah.
So
I read the wrong one, I read the
Oh.
wrong.
244, okay. All right. Now, how would we pay for that? Cash. So cash, we're gonna credit. So we're gonna, this total, we paid all of this. So that comes out to be 1444. All right, so that's what we pay out. So part of it's going to our principal, which is what's payable, reducing it by that much. And then interest expense is the interest that we are paying. All right, so how are we doing so far in this chapter? We've gone through 3 problems. Not too bad. Step away from the, can't waste.
You don't want the camera on me?
I already got that one on me. Hello, everybody. All right, let's take a look at a little more difficult problem, which is 12.8. Exercise 12.8, which is EX 12.8 on page 571. I'll give you guys a moment to take a look at that while I start to set things up a little bit. This one's not so bad.
This doesn't bother you, I hope.
What's that?
That we're.
Oh, it doesn't bother me at all. In fact, I think it's a good idea.
50 pictures.
It's fine with me.
All I did
It's good.
like I said earlier,
That's cheating.
going through the homework,
Why didn't I
with
think
having
that?
examples to work with, it's like, oh yeah, that's what he told us how to do that. And then it just brings it, brings it to life. So that's what makes it fun. Saves phone calls.
There you go. I'm all for that.
I'm not sure about the emails.
All right, so we're going to start with April 1st here. So this company issued a $40 million of a 10-year 8% callable bond. So remember when I said callable, remember what I said earlier? So that's called, they call it at any time. They then owe at that point any interest to that point. If they are in the middle of a semi-annual, or say, if they're 3 months into it, they owe the interest on that, and they owe the full amount to that $40 million. So they may call that a little early because, well, I don't want to pay the interest on it for the rest of the 10 years. As a part of the being callable, usually they'll give you a little bit of more of a higher interest rate because it's callable. Because you're taking a chance that they may call that and you won't be able to get everything that you thought you were getting out of it. So, and some of the reasons you might want to do that too is if you're a company, is if you realize that the interest rate you had on that bond is really high. And interest rates have dropped a lot. And so you may not want to pay that high interest rate, so you'll call that back in and pay it off. And then you may have some other ones you may issue out as a part of that and a lower interest rate. So that may be some of the reasons why you might want to do some of those things there.
Now, this is the buyer or the seller?
This is the seller. This is me as a
Seller has
company.
the ability to call in.
Yes, to call it in and say,
I want my bond back.
yeah, I want my bond back, and I will pay you off because just like our mortgage, we can pay it off many times. Most mortgages you can pay off. Some have a certain amount of time frame when you're not able to, but you can pay it off early. And so this is that, it's kind of a similar thing as that we can pay off the whole thing early if we want to. But just like they get another mortgage, a little lower interest rate. Similar things to that. That's what it's kind of about. Similar to that. All right. So as a part of that, we issued the bond for cash at the face amount. So, well, that's pretty simple there. What are we getting in? We're getting in cash, right? For $40 million. We have $40 million that we are getting. And then we owe some money. So I raised up an asset and then also a liability. As we look into next week, this is a positive thing for cash, right? Now we have $40 million of cash. That's a really nice thing. The bad news is, though, I have leveraged a lot of my company there because now my liabilities have shot up really high. So those are some of the things that you have to balance. All right, so the next part of the problem, it says we paid the interest on the bonds. So we have an 8% bond, and we pay interest twice a year. So what is our interest going to be? 8%.
8% annually?
8% annually. So you pay an 8% annually. So basically, if I'm paying twice a year, that means I'm paying 4%, right? So 4% of that is probably about 6 million. Yeah. You're right. So what do I use to pay for that? Money cash. And then interest expense. What was the date on that one? October 1st. October 1st, okay. All right. Everybody figure out how we got that? Now that's something to really look at, so it may confuse you on a question of the test or a quiz or even on the homework. Make sure that you look at how many times you're paying it that year, because that matters to our interest, right? So, because then if we were only paying it once a year, that means we're paying the whole 8%, which would be 33.2 million. So they just be careful there. Sometimes they trick you up. Just the way it is. All right. So on October 1st, something also happened here. This is in 2018. Called the bond issue at 104. Now, when they say 104, 101, 102, that's percentage. So we gave them a little extra. It's 104% of that. So when you see 104 or you see 98, that means that's 98% of it. See, that's when you see those numbers, that's what it means. So just be aware of that. And then the rate provided in the bond indenture. So what we have then is, and the reason why they did the 104 is they had to pay the interest on it. That was the 4%. So that's why it's 104. All right. So with that, this is 2018. We have bonds payable, right? We call the whole bond, so we got to pay that off, right? All right, what else do I have as a part of that? Remember, I was just mentioning they call that 104. Yeah, interest expense. Good. So we have interest expense. And then that should be that number there. And then I use something to pay that, my cash. And so I'm going to take away from cash by crediting my cash. And that will be these two values together. All right, questions there? So far, so good? All right, so our last problem. you guys take a look at that one. It'll be similar to ones you did done already. This is just a little more detailed. So it's PR 12-1, except this time we have 3 plans. We're just gonna make it a little tougher. I should have just left it when I got up there. So I'll give you a few moments to work on this problem. And as you're doing that, I will set it all up for you. I'm going to do it on a spreadsheet because we're going to have to do this a couple times, so it'll be a lot easier for me to do it that way. And then I'll also put the spreadsheet out there if you want to take a look at it too. So I'll put it on a spreadsheet and I'll put it up there. You're going to use that example in the chapter 2 that will be very helpful to you as you are continuing to work on this problem.
Chapter 12.
Yeah, the example, it was a 544?
Yeah.
Yeah, 544. That was really helpful. That's what I'm putting up here right now. So I'll give you some time to work on that as I am typing away. All right, so let's take a look at this problem here. So we're going to walk through each of these steps like we did before. So he gave us the earnings, right? It says on the first problem, it says 2.1 million. It says determine the earnings per share on common stock for each plan, assuming that the income before bond interest and income tax is 22.1 million. So that's what I'm going to put in here, 2.1 million for all of these. next part of the problem we gotta take a look at here is our bonds. Do you see any bonds in the first one? No, no for the second, right? So we have 0 and 0, and then the third one, what do we have? So we have 9 million, what's at 8%. So what we're gonna do is figure out what we're gonna pay annually on that interest. Because we're gonna take away our, deduct our interest on the bonds. So we're taking the 9 million times 8%.
Could there ever be a question in there about whether or not there were like semi-annual payments where you would have to determine?
Since we're doing this on an annual basis, no.
Okay.
None of these plans will like have that, no.
Okay.
Because we're looking at the whole
Whole year.
Yeah, whole year, what it would affect on our earnings per share. So, yeah.
But if it's like, if we get a question in the same year, it's just like quarterly, biannually, annually.
You'll probably get semi-annual or annual. That's what you'll get.
We won't get any like
Yeah,
quarterly.
usually, really, most of the time you pay it twice a year or once a year. Is what you'll get.
So would you take this number then and go by 4%?
What's that? Well, yes, you just take by 4%. You divide your, so what you typically would do is say this is 9%, $9 million. You would times it by 8% and then times it by another half.
Then cut it in half.
Yeah, cut it in half because that's what you have. You pay it twice a year. Yeah. Or what I usually do in my head is I just take the percentage rate and cut that in half. Either way. All right. So to get this, I'm just going to subtract this minus this. Obviously, that's staying the same. The one over here is the difference. You guys see it okay up there? All right. So now we got to deduct our income tax. To figure out what our income tax is, it gives us the, again, our estimated income tax is 40%. So what I will do then is take this number times 40%. And then this number by 40%, and this by 40%. As you can see in this one, I'm paying a lower income tax because I have deducted out my interest on that bond. So in here, I will take this times 0.4. And then to get my net income, I'm taking the 2.1 million minus the 840,000 that I deducted for my taxes. And then I'm going to basically do the same thing for each of those. Everybody following me here? All right, now I'm going to take a look at my dividends on preferred stock. As you can see in the first one, we don't have any, right? So we don't have any there. So I'm just going to put a 0 in. And then the second one here, I have 9 million. So to get that value, I'm going to take the 9 million divided by the 20, right? So I'm going to divide it by the 20 to give me the amount of shares I have out there. And then I will multiply that times the 4%. Yeah, I forgot
But
about
it
that.
divides.
Yeah, I thought I had it in there, I guess it was. And then fix all this stuff. Oops. Actually, this is 4, sorry. 4%. Wait, no, yeah, because we have 4, what's the, yeah, we take 4% of the 20. So it would be the, it'd be 18, yeah. Well, no, we're taking the 4% of the 20. So it's 4% of 20 there. Let me figure that out real quick here.
Well, we take the 9 million and you divide it by $20 to get how much per share, correct? And then you multiply
Yes.
that by 4%.
All right, so what you need to do here is, you're taking the, I don't know if you see my formula here. So I kind of what you're saying, I was listening to what you're saying there. So basically, I'm taking the 9 million divided by 20 to give me my amount of shares. And then I got to figure out what my dividend's gonna be on that, right? So I'm taking 4% of the $20.
No, you don't take 4% of the,
No, not the value, the amount, no,
No.
we're taking the other $20 and then multiplying it times that. Because that's what I'm giving, so I get, this is my amount of shares I have, times what the actual dividend's gonna be. And so, because it says 4%, it's 4% of the $20 par value. So that 4% of the 20 should be about 80 cents or something like that, probably. I think that 80 cents times the rest of that, like that here. Everybody see that okay? So doing a similar thing for this next one, it's a little different though. This is 4.5 million is what we have here. So this one I took the 4.5 million, divided by 20 to figure out the shares of that. And then we're going to multiply that times the actual dividend. The amount money per share. So we have 180,000 that we are going to pay out in that. Which is, if you look at it logically, you see 9 million, half of that is 4.5 million. 360,000, half of that is 180 million. Or 180,000, excuse me. All right, so then what we'll do is we're going to take away this minus preferred stock. Remember, that's what we did for the EPS. So when we did that equation, it was net income minus preferred stock dividends. And so that's what I'm doing right here. And that gives me my top of there, and then we're going to divide that by the amount of shares we have. And so now I'm going to figure out how many shares I have in each of these plans. So it tells us that we have 18 million shares, or $18 million in the plan one. So how many shares do I have out there? Because it says I have $10 par. That's what I'm issuing.
1.8.
Yes, so I have 1.8 million. So that's what I'm going to put in here. And I'm going to take you out to my dollar sign for this. Everybody see where I come up with 900,000?
No, I see where you found it on the dividend on the common stock, and shares on the common stock outstanding. Where you can make 900,000.
For this one here?
Actually, yeah.
So what I did is it tells us that there's how much we have in common stock. So on the third line, like from the top of page 575, it says common stock, plan 2, 9 million. I divide that by the $10 per value.
Oh.
That gives me that. So that's what I did for each of those. So I took this divided by 10, then each by 10, and that gave me each of those values. All right, then I can figure out my earnings per share. All I'm going to do now is take each of those values, take this number divided by this number here, and I will have to change my values. There we go. So looking at this one, Plan 3 looks a little better earnings per share wise. Okay? So this one looks better earnings per share wise, but now we're going to have to do this again. in a second
Why
why.
would we do it again? We're done.
I'll put this spreadsheet out there if you want to.
Oh,
It'll be out there on Angel. All right, so looking at each of these plans, we can see that plan 1 isn't as good for, at least for earnings per share, plan 2 than plan 3 is. Now, it does depend on how much money you're making. It does. And so those are some of the things that we're going to look at here. So let's take a look at the next part of the problem, because that's half of it, or not even half of it. So that's part 1. So part 2, we have some similar things here. This is why I decided to do it on Excel. So on this problem here, we have a change. We have a change to all of this. The only difference though is now we only need 1,050,000. That change affects a few things here. So if I put that value in here, and this is where it's nice to have Excel, it will change everything for me. All the way down. And as you can see, there's some big changes there. So looking at that, it goes the other way now, right?
yeah.
Yeah, because we've made so little, my earnings per share is really low here versus these other ones. And so that's the second part of the problem. You guys can probably walk through that on your own, but I'll put that out there for you. That's one of the nice things about using Excel. It has all the formulas, just change a little thing, and there it goes. It does everything for you, which is nice. And so as you're analyzing that, you can see some differences there, and you kind of have to project what might be best for your company. How are we doing financially? How we're making, if we're making money? Because if we don't make as much, our earnings per share could be a lot lower. But if we make a lot more, then it's a lot higher. And the reason being is the amount of shares out there. As you can see, there's only 450,000 in that plan 3. But if we're not making very much, like right here, we're not making a lot of money. We're actually only $18,000 available. We didn't have much to pay out. So that's why it was so low. So you can see the differences there. So those are some things you have to look at as a financial person in the company, is how are we doing financially on our making money, and how do we finance everything. Those are some of the things that you have to look at. All right, so questions on this problem, any of the other problems, anything in these 2 chapters? So I've gone over, one of the things that you'll notice though, I covered that probably the toughest question. And this is the toughest question you'll have in chapter 12. The last problem we did in chapter 11 was the toughest question. So I'll make sure I cover those for you to help with some of those, because they really help with the other ones too. So hopefully you got everything that you need. Please let me know if you have any questions or anything. What we will work on next week, next Wednesday at 6, we will work on chapter 14, because we only have 1 chapter next week. And then I'm going to do a review for the final and kind of go over some problems that you might potentially see in those areas there. The final exam will be on the last 7 chapters. It will not include the chapters before the midterm. So you'll have 7 through 14, excluding 13. So you'll have those 7 chapters, and I will walk through some sample problems there for you next week. All right, so questions? What's that? The test, I'll have it out there week 7, so it'll be out there probably on Monday morning. Okay. But my recommendation is wait till you come here. We'll go over some of that and prep you, and then you can take the test. How's that? And those of you online, I'll get it out there for you too.